Logic, School of Management. It is simple logic.
Hi all, now let's discuss Chapter 4, Pricing. We all know that pricing is very important for all forms of business. It affects the selling price, profit, and even the reputation of the company. The various factors that affect the pricing of a business are demand. It has an inverse relation with price. That is, when the price increases, the quantity demanded decreases and vice versa. Another factor is the quality. Higher the quality, higher the price charged. Lower the quality, lower will be the price charged. Then we have competition. In a highly competitive market, the price charged will be low, whereas in a lesser competitive market, the price charged will be high. And then we have inflation. We know in inflation, the cost of the commodities will increase, which eventually result in the increase in the selling price of the products. These are the main factors that affect the pricing of a company. Now let's discuss the concept of price elasticity of demand. It measures the relationship between how the change in price affect the change in the quantity demanded. The equation is percentage change in quantity demanded divided by percentage change in price. If the price elasticity of demand is less than 1, the demand is said to be inelastic. That is, when the price increases, the total revenue of the company also increases, and when the price decreases, the total revenue decreases. However, when PED is greater than 1, the demand is said to be elastic. That is, when the price increases, the total revenue decreases, and when the price decreases, the total revenue of the company increases. Then we have unitary elasticity. That is, either you increase or decrease the price, the total revenue of the company remains the same. That is when PED is equal to 1. Now moving on to our demand function, it is a very important portion. The equation is P, that is price is equal to A minus BQ, where A is the price when quantity is equal to 0, B is change in price divided by change in quantity, and Q the quantity demanded. With this equation or function, we can find the price to be charged to our product and services. This equation will be provided to you in your main exam. Then we have total cost equation. We know the total cost is the sum of fixed cost as well as variable cost. Therefore, the equation is TC is equal to A plus BQ, where A is the fixed cost, which is an independent variable. B is the variable cost per unit, which is a dependent variable. It is dependent on the activity level. Here the activity level is quantity demanded, Q. With this equation, we can find the total cost incurred by a company. Now moving on to very important portion, that is a profit maximizing price and output level. The profit of the company can be maximized if the company sells additional units and when the additional revenue generated is greater than the additional cost incurred. We know additional cost and additional revenue is the marginal cost and marginal revenue. Therefore, the profit maximizing point of a company is where the marginal revenue is equal to marginal cost. In your exam, you can calculate the marginal revenue using the formula A minus 2BQ, and marginal cost is the total of the variable cost. Now let's discuss some of the pricing strategies. The first one is the cost plus pricing. This is a traditional pricing method where you add up all the cost and then add a percentage of markup or margin. Markup is the percentage of profit based on the cost, and margin is the percentage of profit on the basis of selling price. The different type of cost that can be used in a cost plus pricing are marginal cost, that is the variable cost. This helps to fix a minimum price for the product and services. Then we can use full absorption cost, that is the total of variable cost as well as the fixed cost. This helps or guarantees to cover all the cost incurred by the company. And then we have standard cost. The main advantage of using standard cost is that we can set a stable cost with the different efficiency levels. Another important pricing strategy is the market skimming strategy. That is, initially when the product is introduced into the market, the selling price charge will be really high. And once the product mature in the market, the selling price is gradually reduced. The main examples of this are Apple products and Samsung products. The skimming pricing can be used when the demand for the product is relatively inelastic or when the product is new, and also when the product life cycle is short. Another important pricing strategy is penetration pricing. That is, initially when a product is introduced into the market, the selling price charge will be really low, and when the product gain enough market share, they gradually increase the selling price. Examples are Jio and other DTH services. It can be used when the demand for the product is highly elastic, and if the company wants to discourage new entrants into the market, or when the company can exercise large economies of scales. Then we have complementary product pricing. That is, when the products are sold along with another products. Examples are bread and jam, gaming devices and gaming softwares, printers and its cartridge. The strategy here is that either you can charge a lower price to the main product in order to boost sales and charge higher price to the associated product, and vice versa. Another pricing strategy is a product line pricing, where a range of products related to each other are sold. Example is the clothing industry. The price of the cotton goods will be lower than the price of the silk goods. Another example is the beauty products. That is, the price of a product will be related or associated with the price of another product in the same product line. Then we have volume discounting pricing, where discounts are offered to the customers if a particular quantity of product is purchased. The discount is provided in two ways. The first way is quantity discounts, where the discounts are offered if the customers purchase in bulk, and then we have cumulative quantity discounts, where the discounts offered increases in line with the cumulative order placed. Last strategy is the price discrimination strategy, where the company sells the same product with different prices in different market segments. The market segments can be the geographical segment, that is national and international market, or on the basis of type of customers, that is the wholesalers or the retailers, or even the season, that is the price charged in peak seasons and in off seasons are really different. So these are the different pricing strategies adopted by the company.